Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial and business partner Corby McGordon this morning. Our mission here on this podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's going to be sellable or transferable, and then help you exit successfully. For most owners exiting, attracting capital is going to be key for a successful exit. Capital will be needed for an external sale as well as an internal transaction, expansion, growth. And so much of the work that we do here at Ennis Legacy Partners is assisting clients in building financial disciplines regarding cash flow management, increasing margins, building a strong and sustainable financial infrastructure, and all with this goal, eventual goal in mind of a successful exit. And so that's our topic this morning. What investors want, building a financial discipline to attract capital. And joining us for this conversation is guest Jason Kruger. As a partner at Citrin Cooperman, Jason leverages over 20 years of experience to transform how businesses approach profitability and decision-making. He was the founder of Signature Analytics, a five-time Inc. 5000 company. He's passionate about, and you're going to see this morning, about empowering organizations with actionable financial insights. And he's here to join us and sharing some strategies for financial discipline, and then with the goal of attracting capital. So Jason, welcome to the podcast.
Thanks, Pat. Appreciate it.
Hey, Jason, I'm going to start us off. So as Pat said, thanks so much for joining us. You have an incredible background. I'm really looking forward to this because we're going to benefit, and so are our listeners. So thanks again for coming on board. I'm going to start, oftentimes when we talk about the, financial attractiveness of a company, which is one of the aspects of attracting capital, I think at least me, I automatically go to the P&L. Are they profitable? What's their EBITDA? That type of thing. And there's, lots of good reasons to do that. But I want to I want to start off in a different direction, something we don't talk about as often, which is a company's balance sheet. And as most of our listeners know, the balance sheet is the statement of assets, liabilities, and retained earnings. And what I'm going to ask you is, when you look at a balance sheet, what are your eyes immediately drawn to? And number two, what jumps out as a red flag to you?
Yeah, absolutely. I think, and I'm glad you brought this up, because the balance sheet to me is the first thing I look at to really understand the true health of the company or the organization, right? The first thing I look at is I want to make sure that I'm looking at something that's accurate. In the small mid market, the level of sophistication can vary. And so we want to make sure first that we have confidence in the financial information. So assuming we have confidence in the financial information, I'm looking at a couple things. One, obviously, start with cash. So understanding the balance sheet ultimately helps us understand the cash flows of the business. And as a business owner, the most important thing is cash to keep the business running. So if we understand the cash flows of the business, that's critical. I have I guess it's somewhat of a funny story, but it's also a story that, there's room for education as well. I had a company I talked to. They were actually in the brewing industry, and they're effectively manufacturer, and they manufacture beer. And so they have high capital, fixed assets on the books. They have a lot of inventory in the form of raw materials, and then ultimately beer sitting there that's getting ready to be fully prepared. And so I showed up, and the business owner said, "Hey, look at my P&L or my income statement. Look how profitable we are." And he's like, "But I can't even pay my bills. I don't have enough cash to make my next order. I'm just struggling every day." And I said, "Okay, well, let's take a look at your balance sheet. He's like, oh, I don't ever look at my balance sheet. And I was like, okay, well, let's take a look. And I said, we take a look at the balance sheet. I said, well, there's two issues. There's two things, or a couple things that might be the issue here. One is your financials are not accurate. So you maybe are not as profitable as you think you are if you're not appropriately tracking inventory, which then leaks into cost of goods sold. And the other is your cash is all hung up on your balance sheet in the form of accounts receivable and in inventory. So inventory is effectively your cash on the shelf. So when you're looking at the balance sheet, I look at, on the asset side, AR is critical. And what's your AR turnover? How much are you collecting your AR? And that ultimately, or how well are you collecting? And if there's something we could do very quickly to trim that down from, even if it's 35 days to 30 days or less, we're infusing cash, that many extra days of cash into the business. And then when I'm looking at a manufacturing or distribution company, it's really about inventory and managing the inventory levels. And are they overexposed on inventory? Do they potentially have challenges with spoilage or anything like that? And so during the COVID crisis and the all the issues with the supply chain, we had companies that overextended themselves and were carrying way too much inventory because they were trying to buy and they didn't know what the situation was, and they had cash flow issues there as well. So when I look at the balance sheet, I mean, that is truly the health of the business. Managing your AR levels appropriately, managing your inventory levels appropriately, and then on the liability side, it's what's your plan to ultimately pay your vendors and to pay to pay down your debts, and making sure you have a plan on all of those. So from business planning and life, from success of your business from a cash flow and operational perspective, that's why the balance sheet is so important.
Wow, that was really well said. Thank you for that. Just let me do one quick follow up. So you talked about accuracy. How important in your mind is it that a company have audited financial statements?
Mm-hmm. I would say it depends. Obviously, if you have audited financials, there's significant, we can have, or an outside party can have significantly more reliance on the financial information. It depends on what you're using your financials for, and the level of sophistication and investment that you've made in your internal team. If you have strong sophistication in your internal team, your team has processes that you have confidence in the accuracy of the information, you're getting good financial reporting on a minimum on a monthly basis, and then carving out, other types of maybe weekly or daily reporting outside of that, and you have good financial discipline. If you're not, if you're an independent, privately owned company, doesn't have outside debt, maybe not looking to do a transaction in the near term, audited financial statements, maybe probably aren't necessary. A lot of banks will require minimum reviewed financial statements, which is essentially like audited financials, but a little bit less testing to ensure, the overall confidence in the numbers. So unfortunately, the answer is it depends. If you are going to market in the next couple of years, it can add value to that process. It can potentially also give you a couple extra points on valuation because it eliminates risk. A buyer is always looking at risk. The buyer is saying, hey, the more risk, the more I'm going to knock down this valuation and the cost of what I'm going to pay for this business. If you have audited financials that you can provide to the buyer, that helps to minimize how much they reduce that purchase price by.
Mm-hmm. Hey, Jason, you mentioned it in passing, but the idea of financial discipline. Can you pull on that thread some more and just, for a small to mid-sized company, what does that look like practically?
Yeah. I mentioned before. So number one, with a small mid-sized company, when I say small mid-sized, I say, anywhere, I guess, from 0 to 100 million, 10 to maybe 10 to 100 million. But even before you get to 10 million, these are important practices to instill. Number one, from a day-to-day perspective, I talked about it starts with cash flow. So really understanding when we meet with a company or a client and we start working with them, the first thing that we do is make sure we have an understanding of what future cash flows look like. So forecasting cash flow out, because your P&L, as we talked about, earlier, Walter, may say one thing, but your cash flows may say something else. And so you could be deceived by, positive cash flows when your business is actually not doing well, and you could be struggling with negative cash flows even though you're showing profitability. So understanding cash flows and what that looks like into the future is critical. So that's number one. The second, I always say it starts with the day-to-day accounting, then ultimately good processes within day-to-day accounting, which is invoicing, paying bills, collections, processes around how you pay your bills, and so on are important. That then leads ultimately to good discipline around how you close your books on a monthly basis, not quarterly, not annually, not having your CPA do it at the end of the year before they file your tax return. So let's do it monthly. And let's have a good process that when we close the books, we can produce financial information that I, as a business owner, can use to make decisions and achieve the goals I have as a business owner. And that involves, obviously the basics, which is the P&L or income statement and the balance sheet. But then digging deeper. Before we jumped on, I think the recording, I think it was you, Corby, that mentioned, talking to clients about their different sales channels or their different products, and understanding not only the profitability by product line, by as a whole, but the profitability, breaking it down by product line. And that then allows business owners to make better decisions on focusing their level of efforts on what products they should be pushing into the market, which they shouldn't. And so really ultimately with the goal of maximizing profitability as a whole. And so financial discipline, to summarize, I guess, is making sure, understanding your cash flows, looking into the future, ensuring you have good disciplines on invoicing, collections, paying bills, and the timing of how you pay bills, so you're managing cash appropriately. Having a solid monthly close process, which includes timelines, so you understand the dates associated with that, which also includes supporting schedules and reconciling every account on the balance sheet, and then ultimately driving good reporting that you can use to make decisions to run your business. And then as you look forward, and I know that you guys are big into this, which is as I'm a business owner, I want to exit or sell my business in the future. I always want to look at my business valuation. What am I doing at all times to maximize the value of my business, so that at any time, if a buyer comes up, I'm ready to go and I'm ready to exit.
Mm-hmm. Mm-hmm. Yeah, and it sounds like you mentioned the term sophistication. It sounds like it's less about having a Fortune 500 accounting shop as routine disciplines with the staff you have, and then improving. Would that be true?
Yeah, I call it accounting and financial leadership. And what I mean by that is a lot of companies in the mid-market, they have the boots on the ground. They have people that are able to invoice. They have individuals that are able to pay bills, do the day-to-day accounting. But they maybe don't have, or they've maybe outgrown their current team, and so they don't have the leadership at what I would call the controller level to really ensure they have those processes in place and they have the discipline in place. The small mid-market is challenged in, one, there's a lack of overall talent in the marketplace within the accounting and financial field as a whole. The second is that talent can be expensive. So hiring a full-time controller or full-time CFO is expensive for these companies. And they may not see the cost, or they may not realize or understand or see the cost benefit associated with that. And so they end up either kind of sticking with who they've had when they were a $5 million company and now they're 20 million. There's a lot more complexity involved with that. or they try to hire somebody on with a lower budget that maybe has a controller title, but really is still, more of a bookkeeper. And so the challenge with business owners in the mid-market, a lot of them are entrepreneurs, they're first-time entrepreneurs, finance, accounting isn't their background. So they're kind of it's kind of luck of the draw on who they might hire, who they might get. And that is, that's one of the biggest challenges I see in the market.
Mm-hmm. Mm-hmm. Yeah. And then speak a little bit to that idea of a small business owner needs to invest for the future. How do you overcome that hurdle, if you will, so that they actually take the steps they need to take to grow?
So when a company is, positioning for growth, that investment in the accounting function, it's how do we educate the business owner to look at the accounting and finance function not as a cost center, but as a value add to their business. And the way to do that is through the financial discipline that we talked about up front, but then through the reporting and giving them visibility into their financial informations that allow them to improve the business. And an example of that is if question is when I ask a business owner, what are your margins? They say, it's somewhere between 45 and 50%. Well, on a $10 million company, 1% is 100 grand. And if you're talking about margin, that's right to the bottom line. So the question is it 45%? Is it 50%? Is it 47? And if it's 45, how do we get to 46 or 47? And we want to track that to the percentage point, because every percent you can improve upon that is $100,000 of extra profitability that either goes in the pocket of the business owner or can be reinvested back into the business. And so those are the types of discussions and the type of information that we want to be able to show to business owners that transitions the thought process of, hey, accounting and finance isn't a cost center, it's a value driver, and I need to invest in that to grow my business.
Hey, Jason, along those lines, how do you view the responsible use of debt in a business? I mean, I've got clients who, they run the spectrum from factoring their receivables to, to just thinking debt is a dirty word, which, when you're a cash basis taxpayer, I've always found it very useful to have a line of credit available so you can, do some year-end planning strategies. What's your view of useful or of responsible use of debt in a business?
Yeah, I would say that, going back to what we talked about, the more discipline you have around the financial side of your business, the more options you will have as it relates to debt. If you don't have good financials that anybody can trust, you're pretty much limited to maybe factoring, where somebody can say, okay, well, I can understand your cash. I can see you have some receivables here in your operations or your inventory, and I can factor on that. And factoring can be extremely expensive. When you're factoring, you're probably minimum in the 30% range from an overall interest rate perspective. Maybe you can get to the 20s, but it's very, very expensive. If you have better financial discipline and you can tell the right story, you can start to build relationships with banking with banks or banking relationships. And I'm a big proponent of getting to know your local community banks, because they really look at the relationship side as very important to them, and they have flexibility that maybe some of the larger banks don't have. And so getting to know them early in the process is important so they can understand your business. And then ultimately, when you need some level of financing based on whatever you're looking to accomplish with your business, they're there, they understand your business, and it makes it a lot easier to drive to obtain that debt. From a responsibility perspective, I would say you never want to be chasing the money. You want to, it's important that you have the foundation in your business so that you have confidence that the debt that you're using is leveraging your business to move forward and grow. versus, when I talk about factoring, you're kind of chasing that money, and it's a cycle that's very difficult to get out of. Versus better financial planning up front may have allowed companies some companies use factoring in the right way, depending on the industries that they're in, but there's opportunities to potentially have a more traditional financing through a line of credit, which is much less expensive than some levels of factoring. So, that's some of the most expensive types of debt. The better financial information, the more sophistication, the better reporting you have, just tells the story and allows you to tell the story of your business to an outside provider who's going to want to invest in you through, like a bank, want to become a partner with you. And that will, really support, how you leverage your interest rates, obviously, moving forward as well.
Mm-hmm. Yeah, you mentioned in passing that at times people can view the financial function as a cost center rather than a value driver. Love your thoughts on how do financial disciplines relate to strategic planning and the actual ability to execute on a strategic plan.
Yeah. Yeah, well, I'm sure that, Corby, when you go in and if you want to work with a company on strategic planning, probably the first thing you say is, let me see your financials, right? And if you can't trust the financials, you can only do so much, right? And so again, I talked to some companies and they want all this fancy reporting and all this great stuff, but if they don't have the foundation in place to produce that, then you're not going to get good information, or you're not going to be able to dig down at the level that you want to really make an impact on the business. I could just speak for myself from my own experience. So when I started Signature Analytics, I left Deloitte, one of the big four firms, with an idea of really supporting the mid-market, these companies on a fractional outsourced basis, on an ongoing basis. And we had tremendous growth. It started with myself and a computer, basically. And then over time, we continued to grow, and we built the team up to about 75 individuals. And so through that, there's operational discipline, there's financial discipline, there's sales and marketing discipline. So HR, never knew how important HR was until I had my own business, and culture and all those types of things. And so when we were looking at our financials, we were always looking at and trying to apply and focusing on the areas that ultimately an outside party would look at us, and we would be positioned for maximum valuation. And what I mean by that is, the first question is, how are we valued? How does the marketplace look at us as how we're valued? Some are valued on a multiple of like an EBITDA multiple. Some are valued on a multiple of revenue. Some might be, something else. How are we valued? What is the market looking at? How can we maximize value over time through, client concentrations or lack of concentration, diversity in clients, client mix, locations, those types of things. And so all of that information needs to be able to truly drive strategic planning. All of that information, we want all that information at our fingertips. We don't want to spend all of that time trying to figure it out, because that now we're delayed months on end. But if we have all that information on our fingertips and we understand from the beginning, what our ultimate goals are, then we can ensure that we have the foundation to bring someone like yourself in that says, okay, now take me to that next level. I have the information, I have good discipline, I have good numbers. Now let's take that, and now let's say, okay, now what can we do with that beyond this?
Mm-hmm. Mm-hmm. Yeah. So, I mean, what I hear you saying is you can know you're on course for your plan rather than hoping so.
Right. Yeah. Right. Yeah. And then, of course, if you have a plan, it's ensuring that you have a way to measure if you are on track, like you mentioned. And so The worst case scenario is developing a plan and put it in the drawer and then checking next year to see where you're at, right? That's what a lot of people do with their budgets is we got a budget. Okay, great. I don't know if anyone prints it out anymore, but if they did, they put it in the drawer and then 3 months later, they're not, they're off track. They haven't looked at it and it's useless. So they're not using it to maximize how they run their business.
And one other question along this lines, when we talk business growth, obviously sales, business development really is the driver behind financial disciplines. How do they relate? How should they relate in the mind of an owner?
Yeah, I like to talk about this because as a business owner, part of what I've seen not work very well is a business owner, they understand a product or a service. They decide to go out on their own and start a company around that knowledge base that they have. And they say, okay, great. I know the product or service, so I can initially maybe sell it. I can perform the work, or I can oversee the process to perform the work. And then they say, when I get to a certain size, I'll just hire a bookkeeper and they'll do the accounting. I'll never have to worry about that. And then I'll hire a salesperson and they'll sell and I won't have to worry about them. And then, they think it'll just all magically work. Well, what ends up happening is if that business owner doesn't educate themselves around the different aspects of their business, then there's a lot of hope involved. They're crossing their fingers, hoping they hired the right sales guy. The salesperson doesn't have any direction or discipline in themselves. And so they're off kind of doing their things. And 9 times out of 10, it doesn't work. And so when I talk to business owners, the thing that I always like to say is you have to educate yourself and understand all aspects of your business. You need to hire the experts, of course, but you still have to manage those individuals, ensure that they have a plan that they're executing against, and measure their success against that plan. And you have to start to become an expert in those fields. My background is not sales and marketing, but I know a lot about sales and marketing now because I've had to learn it and run the business. Whereas I know that if I just hired a sales team and didn't pay any attention to them, we probably would have gone out of business. And so same thing with accounting. You have to hire the experts, but you have to provide that leadership of those individuals to continue to drive forward. And so when we talk about the sales function of a business, as it relates to the finance side too, it's make sure you hire good people, you provide them with good leadership, but we also, when we're going through our budgeting process or we're forecasting out for the year ahead, we have to understand the cost benefit and what our expectations are as it relates to the sales team to ensure that we are that we're profitable and driving profitability from that team as well.
Hey, Jason, in that regard, our last podcast, we had someone talking about incentive compensation plans. Are you a big proponent of those?
Yeah, as it relates to management or
Like your sales team and other positions like that. Yeah.
Mm-hmm. Yeah, definitely on sale, for sure on the sales side. Our services are the services that we perform. The way we're structured is our base level compensation is probably a little bit higher than other industries might be because we need sophisticated individuals within business development that can speak and build relationships or have relationships with the CEO level or management level. So we have to have a higher level of base compensation initially to start there. But it's usually in sales, it's a combination of the base plus the commission structure. Commission only, I haven't seen work very often because you don't have any skin in the game, and to bring in somebody that's really strong and solid from a business development perspective, you want to partner with them. You both want some level of skin in the game. They want to see it from you, you want to see it from them. They want to believe in your product and your service. And if you say, hey, you know what, come on in, I'm not going to pay you anything unless you sell commission only, they're not gonna they're gonna feel you don't believe in your own product or service, and so, or believe in them enough to make that investment in them. So usually it's some level of commission and base there. But on top of that, what we did at Signature Analytics is we had developed a phantom equity plan, which basically was revalued and rewarded them, at a time of potential exit. So it wasn't direct equity, but it acted similar to equity at the time of an exit. Because we did exit, everybody was the individuals, the key individuals within our team were able to participate in that. And, and it was obviously very rewarding to them. So different things like that, for key individuals and key management can be important. So whether it's some sort of a stock plan, phantom equity, like we talked about, some other incentive plans based off of overall performance of the business. Maybe I've seen companies do a percentage of, profitability above a certain baseline target can be shared within the organization. All of those, really, it's about building the right culture and building so that everybody is working together to drive the ultimate results that we want to achieve as a business.
Yeah, we've had a lot of discussions recently with different clients regarding phantom equity, and even some who really want to distribute real equity. We always try to steer them to phantom first. But Senator, so your phantom plan only paid off in the event of a transaction?
That's right. Yep. And so we carved out a certain percentage, equivalent percentage of our equity, and then we didn't distribute it all on day one. So it allowed us to distribute it over a period of a few years. Now, we were fortunate because we within 4 years of creating the plan, we exited. So it was great for everybody. The challenge is if you create a phantom equity plan and you never exit, well, then people can start to get, a little bit, think that it's basically worthless, which in fact it is worthless. On the opposite side of the spectrum, I've seen business owners who are overly, and I'm sure what you were alluding to earlier, Walter, is they're overly just kind of throwing equity. I'll just give them 5%. I'll give them 5%. And they don't really understand the impact of what they're doing, because they haven't had the experience, in that space before, of just throwing around equity like it's a birthday gift or something.
Yeah, so this has been a fantastic conversation and great content, and the listeners are going to very much benefit from this. Before Walter wraps us up, I want to ask one last question, and it has to do with the title of the topic today: building financial discipline to attract capital. When we're talking to owners about that, Jason, building disciplines to attract capital, one of the things that we're going to say to them is, if you're able to do that, if you're able to attract capital from numerous sources, you're going to maximize your options for exit. So you want to speak to that in closing here in regard to the importance of attracting capital in your eventual exit?
Yeah, absolutely. I mean, it's all about telling the story of your business. And the first question most outside parties are going to ask you, when you are talking to them, is, let me see your financials, right? So you can tell them the story verbally, but then you want to tell the story through the financials. And it's a tremendous opportunity for the executive team or the business owner to tell that. There's a tremendous opportunity to tell that story. And unfortunately, most business owners don't realize that or don't see that. And they just hit print on QuickBooks or whatever accounting system they have, and they send it off to the third party who is looking to either invest in them or provide them capital, and they allow that third party to create their own story. And it's a tremendous missed opportunity, because that is your shot to tell your story of your business through your words that are backed up by the presentation of your financials. And I can tell you, if you hit print, if you're talking to somebody who's going to invest in your business or even provide you capital through financing, you're going to get a better valuation. You might get a better interest rate. You might get a higher percentage chance that you're going to close that deal if you're able to come to them with a story, with your own story, with solid financials that tell the right story, that look professional, versus if they just get, financials that your bookkeeper sent them. It gives you credibility, and they know you're serious, and it's crucial. And the last thing I'll say, when we were acquired by Citron Cooperman, we closed in 60 days from the moment we received we agreed on an LOI. And that's because we had everything in order. We were ready to go. We were aligned with Citron Cooperman. They did a great job. We were on top of things. We told our story. They told theirs. We were aligned, and we moved forward. I've seen situations where obtaining capital takes months. It breaks down. They try again the next year. But if you have everything in order and you could tell your story, and I'm not saying tell a story that's false, it's accurate, it's backed up by data. When they ask questions, you have the supporting documentation that you can provide them. And all of that is, you have your ducks in a row. I mean, it could be worth millions of dollars just doing that to a business owner.
Yeah, that's really good. Yeah, I've seen that accomplished by, along with the financials, you kind of give them like a little history of the company. Like, 2021 we added 2 salespeople and sales grew by
Yep.
X. Stuff like that. Yeah.
Yep.
That's a
Absolutely. And that's part of, when they say EBITDA, I mean, EBITDA is it's a little bit, it's not a black and white. EBITDA is not black and white. There's carve outs. There's, you want to tell that story. Hey, we made an investment last year into sales individuals. That's why our EBITDA percentage went down. Look at the results we're getting from them now. So let's add those back in, so let's make sure that we take that into consideration when we're looking at our overall profitability. Let's take into consideration one-time investments we're making now to grow. And so you can carve those out to show, what an EBITDA rate or percentage might be without certain costs that, you want to show the buyer, or you want to show them, or whoever might be providing you capital, what they are buying or investing in, not in the future. So if you incurred a lot of costs to get to where you are now that aren't going to be there next year, you want to let them know. And if you don't let them know, they may not know about it, and they'll devalue your business.
Yeah. Jason, this has been really fantastic. So thank you very, very much. Before we leave, 2 things. Anything you want to promote today, and how could our listeners get in touch with you?
Mm-hmm. Yeah, I love talking to business owners. At Citron Cooperman, we're a full-service CPA firm, which includes tax, audit, and advisory. My focus is in the advisory side. Still working, we work with small, mid-sized companies nationally to really work with them, to support them. My focus continues to be on the outsourced accounting and advisory side, providing that accounting and financial leadership that clients lack in a flexible, scalable way. So giving them that leadership, and filling in the gaps, but on a cost point that really makes sense for them. Love talking to any business owners if they want to reach out. I can easily be found on LinkedIn. Jason Kruger, obviously at Citron Cooperman. And then if anyone wants to shoot me an email, I'm always happy to talk to anybody. I like to say, if I don't know the answer, I probably know somebody I can introduce you to that does. So happy to talk. It's the letter J, Kruger, that's Kruger, at citroncooperman.com.
Fantastic. Thanks again, Jason. Really appreciate it.
Yeah. Thanks, guys. Really appreciate it.
And listeners, if you want help in maximizing the value of your business or planning for your eventual exit, you can contact us at Ennis Legacy Partners through our website at ennislp.com. Thanks for listening. And if you benefited from today's episode, please consider liking and sharing it on social media. And as always, until next time on the Exit Readiness Podcast, this is Walter Dial, Pat Ennis, and Kobe McGordon signing off.